Let's go ahead and get started. I want to make sure we have questions at the end. Time for that. I know these guys love to talk. So my name's Ethan Preet. I work with MX. I know it's intimidating. You see a guy like me and you're like, man, that guy, he's big. He looks muscly. I know what you're thinking. You don't have to say it. In fact, don't say it, please. I have this headset. I begged for it. I actually don't even need it, but I wanted to feel cool, so I wear it. But happy to be here. The question we were just joking for this session is financial wellness a pipe dream? And I'm glad you're here because that probably means you've asked yourself that question. And so you're going to hear the answer today. So get ready. If you don't, there are tomatoes under every chair. You can go ahead and throw those after. But let me go ahead and introduce JB quickly. And they can do introductions. And honestly, JB needs no introduction. The only reason I wanted to do this is because I am very opinionated about the fact that he looks exactly like the actor John Hamm. So if you've ever seen Mad Men before, and if you haven't seen Mad Men, Google it right now and you'd be like, oh yeah, that's definitely him. So after he finished however many seasons there were of that show, JB is the co-founder and CEO of SavvyMoney. Fantastic man. His last name actually means ear in Italian. I'm not sure what that's representative of, but it's a fun fact for you. And I'll let him do his intro and then everybody else. So give it up for this group right here. Thank you.
All right, thanks everybody. Looks like we had a couple more people coming in. So I'll do my intro last. But before we get started, we just kind of wanted to get a read of the room. So want to find out how many folks are from banks. Raise your hand. Got it. How many folks from credit unions? And then how many fintech, MX? Awesome. Oh, wow. Good representation.
Good mix. It's a good room.
Well, good. So I'm JB Orecchia. I'm founder and CEO of SavvyMoney. I'll give my intro in a second because I'm the moderator, but then they lost one of the panelists. They're like, can you be a panelist and moderator? I'm like, I guess I can scratch my head and rub my stomach at the same time. So I'm going to try and do both, but I'm going to let these guys take the floor first. So Chris Courtney. He's got a long title, so it's going to take me for a second. Head of Science, Risk, Analytics, and happy at Happy Money.
That's right. I get paid by the letter, so try to lengthen that thing out. So hi everybody. It's nice to meet you guys. As JB said, I run Science, Risk, and Analytics at Happy Money. I really see my team is composed of data science, business intelligence, risk, and UX research. And I really see my team as the data intelligence wing of the company. We help figure out who to reach out to. We help figure out how to make decisions at scale. We help figure out how to reduce friction within our funnel, make the process much easier and the experience better for our members. And we help build a robust portfolio and make sure that it's serviced well and we know who to reach out to when they need help.
So Chris, a little bit of your background, because the science part
I'll do the background thing too, yeah. So I didn't have the most traditional path to a career in finance. I started out in academia. I'm a cognitive neuroscientist. In my academic life, I was actually working on building adaptive virtual reality environments for military training simulations. So I would hook people up to a bunch of electrodes, see how they were responding to high stressful situations, and then make adaptations in real time based on those physiological responses so that we could train people to make better decisions under high levels of duress. And after that, I went and worked at the Veterans Hospital in Long Beach for a few years, working with patients with PTSD and looking for biomarkers of positive treatment outcome for a number of different treatment options.
So a direct line right into financial
Straight
wellness.
to finance after that. It made a lot of sense for me. So what I did had nothing to do with finance at all, and we'll talk a little bit about how we came into financial wellness and things like that, but it did have a lot to do with personalization at a very granular level and dealing with lots of data, lots of very messy data. What I deal with in finance is actually so much cleaner and more fun for me. But yeah, what happened was the original...
All right, we're going to give you that shot in a second.
Fine.
All right, Akshay.
JB knows when to move on.
Krishnaya. I got to cut him off. Well, he gets a little, talkative.
I can go.
So, founder and CEO of Line.
Thanks, JB. Akshay Krishnaya, founder and CEO of Line. Prior to this, I was global product head for research labs at PayPal. Have a little over 75 fintech patents. interesting thing about me is I took a hiatus from PayPal. I grew up poor. That's my connection to financial wellness, and wanted to get back into the community before I start Line. So became a Uber driver full time. I've done 36,000 miles, covering everything from Fresno to Folsom. So you could say Southern California to Northern California, trying to understand my customers, and soon after that started Line.
Awesome. And so my background, been in finance now 34 years. I know I don't look that old. But started my career at Household in lending, and we'll talk about that in a little bit. Left in '98 to become one of the founders of FreeCreditReport.com and Free Credit Score. You guys probably remember those crazy ads on TV, but we were the first ever pioneer delivering credit reports over the internet. And then for the last 11 years, SavvyMoney. So you'll hear a little bit more about SavvyMoney today, but we integrate with, I guess we just passed 930 financial institutions. Show of hands if there's any SavvyMoney clients in here. Boy, usually the percentage is higher in a room, but that's okay. They're all at a different conference. But yeah, super excited to be here and talk about financial wellness. I've been working on it now for a long time in my life, and excited to have these guys up here as well. So let's get started with a few questions. So the first question really is, what was your first exposure to the need for financial wellness, or early on in your career or your life where you were exposed to it, that really kind of was the genesis for you getting started in the space now?
Here we go.
So you can go, Chris.
Okay.
Yeah. If you talk too long, I'll hit you.
Okay. So for me, I grew up, I think similar to the way that the new MX CTO was talking about it. My family was poor, mostly because we spent more than we were bringing in. We didn't necessarily have to be poor, but, or maybe we did, I don't know. My mom was a nurse and a waitress, and she was a single mom raising 2 boys. And so we struggled financially, but the way that we thought about money was, we don't make enough to save anything, so if we have anything, we're gonna spend it, and we're gonna enjoy our lives. And our financial planning was really hoping that things are gonna get better in the future, and not really taking a lot of action to make that happen. But that actually carried on into my life too, and my approach to financial wellness for myself was really, the same kind of mentality. If I have anything, I'm going to blow it. The money that I do have is really just the money that's the leftover balance on my credit card, basically. And so if I had any room on my credit card, that's how much I have to spend right now. And so I would literally go to bars with friends or something, and if I was buying a round, I'd say, this is me betting on myself in the future. Cheers to that, guys. That's run it up on the credit card. Now, I made the really wise decision to go into academia to counteract all of that and make a ton of money, right? But it turned out academia doesn't pay that well. And I did find out that when SavvyMoney reached out to me, the former chief scientist there was a colleague of mine, and he asked if I wanted to come be a data scientist. And when I came and talked to SavvyMoney, they told me that they're really interested in understanding the connection between psychology and finance, and how our psychological mindset actually affects the way that we spend money, how we save money, how we build up debt, all those sorts of things, and really understand people holistically. And so to me, that was really impactful, and that's research that I was really interested in doing, so I'm really lucky that I've been able to do a lot of that research. And I'm thankful that being a part of a company like this that really wants to do the right thing for people has also helped me figure out how best to do the right thing for myself. So like the financial wellness piece, it's affecting for me and for my family now. And I hope to bring the same thing to our members.
Akshay.
Like I mentioned earlier, grew up poor. Parents came from extreme poverty. My dad's village got electricity in '97. My mom and her 12 siblings grew up using coconut shells to heat water, and the soot that remained, they would use it as toothpaste and dishwashing liquid. So that's the kind of background I come from. Smart individuals.
Good to know in a pinch, by the way.
Smart individuals, hardworking, but still always made mistakes, and that was my understanding growing up, that often it is not a function of people being bad with money, but it's because of they are juggling so many things, especially if you're poor, and the psychological effects and the effects of managing a lot going on in your life has an impact on how you deal with money. So that was my experience. So that's the lived-in experience. I did well for myself, and I made the smart choice that probably my parents and grandparents didn't make, is all of my finances are managed by my wife. So women are good with money. That's my belief. And 60% of Line's users are women, and so we do very well. The experience becoming an Uber driver and again trying to understand where the community is at today, that was my second leg of my journey in understanding financial wellness and real challenges that people face, especially when most people have fluctuating income, even when they are in full-time positions. So those are my two experiences with financial wellness, and with those learnings we built Line to counteract some of those things and meet people where they're at.
Yeah, so my story's a little different. I started my career in household finance. Anyone know HFC or household finance back in the day? Probably dating myself. But we used to actually go out to consumers' homes, and we'd be at the kitchen table, and they'd pull their finances out. And it was always telling when someone went to get their box of finances and pay stubs and like dumped them on the kitchen table. And you're like, whoa, now we know why this person's not that organized. But also just those conversations that you had with folks about their struggles and their understanding of credit and how confused they are. And then fast forward to my time at Household Credit Services, which is on the credit card side, we used to mail a product that was a credit report in the mail. So the early credit report products, and folks would call us and say, hey, I'm going to close on a mortgage. I'd love to be able to get this tomorrow. Can you overnight it? And so we started thinking about, wow, this is a perfect product for the internet. And so freecreditreport.com was the first company to ever deliver credit reports and explain them over the internet. So that was it was really solving a problem. Fast forward now to SavvyMoney, I looked at Credit Karma. For those of you who don't know, freecreditreport.com and Free Credit Score weren't free. It was a subscription service. And Karma came into the space and made it completely free. And so I thought, geez, if you're a bank or credit union, do you really want your customers going to Karma and then losing them? And so really the genesis of our business for SavvyMoney was bring all that in-house, bring that financial wellness, that financial literacy, pre-qualified loans, drive all that loan volume to the participating lenders. And for those that are SavvyMoney clients, you know that. And so that was kind of part of our journey. But really along the way, just solving problems for something that's in place. So let's bring us to our next question. So along those lines, what are we seeing in the market in terms of financial wellness that is really cool, that you like? And then save that for questions later too when we get to that part, because I'd love to hear about other products in the marketplace that folks are excited about. But for now, I'm going to ask the panel. So I'm going to start with that. We're teeing it up. So not with a specific product, but to me, what I'm most excited about, and I geek out a little bit when I talk to Chris, is the power of data, the power of personalization, prioritization, and goals. And what I mean by that, around data, really mining that data so you know what to do for which consumer. Second, the personalization. People want personalized offers. They want you to tell them what to do. And so I'll hand it over now, and also turn off my phone because it's going on.
Sure. Cool. So yeah, I'll build on what JB was just saying. I'm also very interested in personalization and what alternative data can really do to drive personalization for us. We're right now building a personalized offer system that really takes in a very holistic understanding of a person's cash flow, their financial picture, their credit history, all of those things. But we really focus in on transaction data and cash flow to really understand what offer can we make to this person that will really suit their needs the best? What's a payment that they can make without having to drastically change the way they spend money? Because this is a shocking revelation, but we have found, and the data supports this, that when people can afford their monthly payment, they actually are a better risk and they don't charge off as readily. I know that one's like a world beater, but it is totally true. And so we try to understand people's financial spending habits. We're building a system where we can be very transparent about the reason we're making the offer that we are, and we want to make it customizable for them too. So we'll make the offer. We'll say, this is why we're making the offer. These are the transparent metrics that are behind it. You can then take it and customize it to fit your needs, because you know yourself better than we do still, and that customization just is another feedback loop for our models, and our models can just get smarter in the future and make better recommendations going forward. So I'm very excited about personalization. It gives people something that they can actually afford, and it gives them a sense of real agency in the process. Like, they're actually taking control of things for themselves. We're not dictating what they're doing.
I want to double click on what JB and Chris said. Another way of putting it is meeting people where they're at. I think that's really where the world is headed in everything. That is true of financial services as well. So things that are interesting, exciting, stuff like what Daylight is doing for the LGBTQ plus community, or Stitch is doing for the incarcerated community, or Majority is doing for immigrants, or what Line is doing for the 64 million who are credit invisible, where we are giving them a genuine report of their financial health, but not just giving them the report, giving them the impact of that report, what they can see the impact with our services, with other services, as well as recommendations. What can they do with that? And meeting them where they're at. More often than not, we don't talk in terms of percentages. We actually give dollar value so that these folks can understand. We don't try to put crazy graphs in front of them. And also collaborating with them. So, when medical situations started changing, especially for women across the country, we immediately created a microsite, financial wellness microsite, to understand what problems they are facing, and we just uncovered what was happening at the intersection of money and wellness, and that is allowing us to build new products to support them there. And so meeting people where they are at, that's what I'm excited about, both for Line as well as what's happening everywhere else. And I'm excited to see that a lot of banks and credit unions are now having heads of financial wellness in place to head in that direction, which is also exciting to see.
Yeah, I think data's playing a huge part in underwriting as well, right? If you look at a lot of the underwriting models that have changed from the traditional underwriting models, using that data, using that cash flow, using that transaction behavior really gives you more insight than just the score alone. Obviously, score is super important because there's a lot of things that go into how you would manage a score and managing your financial life. And so those things together are super powerful, but I like where it's going. It's much smarter from an underwriting standpoint. I've been in underwriting for 34 years, so it's an exciting time. All right, so the next topic, what impact did the pandemic have on your business? Positive, negative? So I'll start with you, Akshay.
For us, it's been positive from the sense that we got to meet people when they were acutely stressed out about their finances, work with them, understand what actually would make sense, especially for our segment, which is the credit invisible, and understand what are the challenges that they face and build genuine product. The result of that, the dividends of that, we are seeing now. We provide cash for emergencies without credit checks, income restrictions, or interest as part of a monthly subscription that starts as low as $1.97. Sorry for the shameless plug, but had to tell you. And we have seen that number grow dramatically. We have done close to 1 million. We have prevented over 1 million financial emergencies for this segment. We have grown double digit by collaborating with them. So it's had a positive impact from that perspective. It's negative for our customers themselves, but it allows them to be honest. It allows them to really bring their true selves and work with us to solve these problems. Chris?
Yeah, similar for SavvyMoney, the pandemic for our business was actually fairly positive. We found that during that time, I think a lot of people were really looking at their financial pictures, reassessing things, thinking maybe it's a good time to consolidate debt. We're not spending as much right now. Everybody's kind of locked down. And so at SavvyMoney, and I should have mentioned this earlier, like our core business is really built around debt consolidation, and we partner with credit unions who fund our loans, and we bring full service underwriting and servicing of those loans, and provide a national footprint for our credit unions as well. But so yeah, we really saw that people were really starting to look at their financial pictures, come to us. Our demand grew incredibly rapidly. We also, because of our credit union partners, we have really attractive cost of funds, or access to really attractive cost of funds. And so we were able to keep going forward during the pandemic when a lot of our competitors were starting to back out of the market. So we saw a real massive increase in demand. It meant that my team had to come in and really start to help scale or build verifications and different processes to really help us scale. We had a lot of manual stuff going on before that. So automation, it was like a huge driver of automation. It was a huge driver of growth for the company. And hopefully we've helped a lot of people, consolidate debt and take control of things during that time.
Awesome. Yeah, for me, I kind of took a little bit of a different approach to it. No one's at work. They're at home, working from home, so they could spend much more time on their SavvyMoney application analyzing things because their boss wasn't looking over their shoulder. So there was probably more of that time. But we did see also a fair amount of engagement around loans. So one of the things that we do in our product are pre-qualified loans. That's another key thing I think that's changing in the market, right? Being able to always see what you qualify for before you actually apply. Consumers don't want to get that inquiry on their credit. But just because they couldn't go into branches, we saw a lot more activity in terms of our product and a lot more loan activity actually happening within our product because of the pandemic and because they were home. So pretty exciting stuff. Okay, so as a follow-on to that, do you see a change in behavior based on engagement, right? So is engagement in your product, do you kind of double check what consumers are doing, track click behavior, and see if there's an impact to engagement and performance?
One of the core things that we do as a product is we create our financial health report is an index. It's not a score, and it has 4 indices in them. One of them is our app engagement index. So we are basically forecasting individuals' financial lives into the future. It's 5 days, month, 3 months, 6 months, and a year, and then we're telling them where pitfalls are possible and what they could do about it. And we check those indices and we tell them that, hey, this is coming up and you're not engaging, and this is the impact it could have. And we have seen that kind of engagement go up. And as that engagement has improved, especially for those individuals, we see better performance. We see them as better actors. We see them taking funds, returning funds, and being more practical with their money. And so that's been our experience, Chris.
Yeah. So with us, we have one example that I'd like to bring up where we had a mobile app in market for a couple of years that was fairly lightweight. I had a really great onboarding experience. We didn't build it out too much further past that, but the one thing that you could do in the app was really go through your transaction history and rate your transactions as something that made you feel happy now that you're reflecting on it, or something that you kind of regret or you have remorse, it made you feel sad. And with just that interaction and like the very light insights that we would give people around that, we saw the people who had loans with us who are also engaged with that mobile app, they outperformed expectation by more than 40% with just this very light touch engagement. And all it really was, I think, is that it really brought the way that you spend to the front of your mind, top of mind. You're actually paying attention, you're taking consideration for the next time you go out and make purchases. Is this something that's going to lead to happiness with me? And that, just having that level of engagement with your own financial life, then also kind of trickles down to mitigating risk, making you pay attention to making your payments on time, all those sorts of things, and put people in a better position. Just awareness. So engagement's super important.
And so, kind of adding on to that, how are you tracking it on both your sides?
We do it on the app, but we also do multi-medium. So a story behind line, most of our customers we acquire organically. We get about 50 million eyeballs to our properties every month, and that we have scaled over time. And that's because we hired young journalists who are mission-oriented to write content. That's what drives most of the traffic to us, and then gets converted into paying customers, of which we have close to 1 million today, and increasing double-digit. So we see that engagement, and we have seen that engagement actually go up during the pandemic, and even with the inflation coming in. And that is further translating into better business. So we are measuring that both on our app, but also across medium, across all of our properties, the email notifications that we send, the SMS notifications that we send when we forecast their lives and tell them a potential pitfall that is coming up. And so that's how we are measuring, and that's what's helping us and our customers.
Yeah, I think at the end of the day, what you measure, you'll manage. And what we see is those that log into the product and are going in, and we track this by age, by demographic, across the board, even by credit score band. So if you have a high credit score band, what are you looking at? If you have a low credit score band, if you're older or younger. But what we clearly see is those that are going into the credit report card and understanding the factors, we see them move. We see that traction over probably 6 months, 12 months, and then 12 months plus. And that's all available in analytics to all of our financial partners. They can go in and see this movement of people that are moving an entire credit band. They can also see that engagement in loans is there too. So why is the loan engagement interesting? Well, it comes back to personalization. We identify an auto loan. We show you what your interest rate is. We show you what you could save. And so it's personal, right? You may not know that you could qualify for a lower payment on your auto loan. Or we show you personal loan consolidation like what you have, add up all your credit cards in this rising interest rate environment, kind of good to consolidate credit card debt and get a closed-end personal loan to pay off that bill. And so we see that click behavior, and we also expose all of that click behavior and everything that's happening with the consumer to all of our financial partners. There's a whole dashboard. They can even see market share movement by credit score band for every loan product that they have. How many are with them? How many are with other institutions? That data is super powerful. Why? Because you can see where you're competing. If in the lower credit bands, all of a sudden I'm not lending to that audience, and Cap One, Ally Financial, and Santander is scooping up that business, then I need to go to my underwriting department and say, yo, why aren't we getting a little more creative with how we lend to this audience? Cap One's not little finance company or some kind of payday lender. Those are real lenders stealing your business, and you can see it every single day show up in your analytics report. So I think giving the power to financial institutions is super powerful so they can make decisions. All right, next question. Did you have another tracking one you wanted to answer there, Chris?
I had something related. It might be...
Awesome. No, go ahead.
So with tracking, obviously we track interactions throughout the experience with us, from the time they start the application through how often they log back into their member portal, how they come in to make payments, all those sorts of things. We're tracking all of that. I feel like we can do more, and one of the things that I'm most excited about is to get into the area where we're not just providing loans, but we're also providing solutions to help people, pay down their debt but stay out of debt. Because a loan in itself is just a single transaction. It's a one-time, it's one moment in time where you get kind of a windfall, and you can use that to pay down a lot of the high interest debt, but...
You need to change behavior.
But you don't change behavior just based on a loan. Loans don't change behavior. So you really have to attack the root causes. You have to develop a system and put people on a trajectory for success, not just, here's a loan, we hope it works out better next time, and you figure things out. And so I want to really drive more engagement and have longer lasting relationships with people and keep. It's also a great way to have access to a bunch of incredible data, to pre-qualify people for loans when they are qualifying for them, to reach out proactively when we know that they could use a hand from us. So that's
Awesome.
one of the things I'm focused
So what's the biggest roadblock you guys are facing, or you think consumers are facing, either your business or consumers?
So currently, we're not experiencing a ton of roadblocks. We're experiencing similar to the early part of the pandemic, we're experiencing a lot of demand because, again, we have partnerships with credit unions who have really attractive cost of capital. We can kind of price a little bit better than a lot of our competitors currently as interest rates are going up. So we're seeing a lot of demand coming our way again. But we're seeing all of that demand coming during a highly volatile economic period, right? So it's demand that we love to see, and we want originations to grow. Of course, we want the business to grow, but we have to be very, very careful about the way that we're intaking those people. We're making sure that we're giving loans to people who can actually afford them, and who we're not putting them in a terrible position by giving them this loan either. So the biggest roadblock really is just being able to really accurately understand risk in this environment, giving loans to the right people, putting people in the right position going forward.
Thanks, Chris. The roadblock, at least from our perspective, because we serve a specific segment, we serve the 64 million credit invisible, the roadblock that we see is continued perception. So the perception seems to continue to persist that these are bad actors when they are actually not. Actually, our credit portfolio has improved 3x during this inflationary environment when the economic situation is bad for this segment. Our charge-offs are close to 1%, which you only see in the super prime. And so through our product, through our innovation, we're trying to change this perception. But this perception is there, and we see from our vantage point, we think that is the genuine roadblock that exists. And as an ecosystem, we need to work together to change this perception, because a majority of these people are young. Most of our customers are between 22 and 37. A lot of them are in the younger section. They're hardworking. They're in their working prime, and as you've seen in the reports, the unemployment rate is really, really low. So these people are working. They're in jobs. It's just because of corporate policy and public policy, they have a cash flow situation, but they want to do the best, and sometimes it's not in their control. So that's what I would say is a genuine roadblock that we can all work together to change.
So along the lines, you started talking about interest rates. So what's the impact of interest rates to both your businesses?
So I kind of touched on it, but the interest rates going up actually kind of lead to more demand for our loans, because we're able to outprice our competitors because we have access to better costs of capital. So that's really been the main thing. Yeah, I don't.
So for us, we've seen just a change in behavior and consumer behavior. Our clicks on mortgage refis have gone down, and our clicks on home equity loans have gone up. So folks are deciding, I can't get a lower rate, so I'm not going to move. I'm going to fix up my house. So you have to reposition those products with your consumers in order to meet the needs. Credit card rates are variable, so those are spiking. So we're seeing the consolidation of personal loans actually go up. So I think as interest rates change, you need to reposition your products with your consumers in order to meet the needs of that changing environment. All right, we just got the 10-minute thing. We're going to do one last question, and then we're going to open it up for questions, because we have no clock here. So I was flying blind on
how much time we had. Thing,
okay, go ahead.
To that question, we are seeing a very interesting trend. Discretionary people have reduced discretionary expenses, and their actual expenses, their needs have they have gone up. Like rents have gone up, and they find it challenging. They're focusing on that, and they're being more practical with their money. That's also directly correlated to our improvement in portfolio risk. So that's something that I wanted to bring to your attention, especially for this segment, the 64 million.
Yeah, and that should have an impact on inflation, because if you see that kind of cut back a little bit, then the inflationary concerns should start to subside. So the last one I'm going to say, and then we'll open it up for questions, is really around, do you think there's value in integration into digital banking of the financial service partners, or do you think it's better for the consumer experience to be a standalone experience? I think the three of us have differences of opinion up here. So Akshay, I'll let you go first.
Sure. I definitely see a value there, but I see it both ways. For example, if you're a white label solution provider, getting distribution is great, and it makes sense for the entire ecosystem. On the other hand, like services like ours, for the ecosystem to integrate us, there are 113 million credit union members. Banks have even more. And with all of your users, you are saying no to a lot of these people. Like I said, 64 million plus are credit invisible. So often you're doing soft credit checks and you're saying no to them. Don't say no, soft land them, send them to people like us where, we can tell them why they're seeing what they're seeing. We can also share that report with you. So it works two ways, I see. And so, yes, distribution is important, and it can work both ways. That's our opinion.
For us, I think we've had a shift in mindset, and maybe this is a slightly different lens on this, but earlier on, we felt like SavvyMoney needs to be the brand. If you're going to work with us, if you're a credit union that's partnering with us, you're going to do it through our brand. You're just kind of plugging in the back end. You'll provide balance sheet, but we'll manage everything else, and it needs to be all SavvyMoney. We need to grow. That brand is everything. And we've kind of completely shifted that thinking, and our thinking now is that if the credit unions like what we're doing and they want access to our lending as a service, and pick and choose different parts of it that make the most sense for them, then why not let them have that? If we think that what we're doing is positive for the world, then why not distribute it and embed it within other people's or other companies' platforms? And so, yeah, I think embedded finance is amazing. I think open finance in general is a fantastic thing. I'm a data guy, so I love data sharing. I want everything to be open and transparent for people.
Yeah, so I'll kind of finish up on this one. Our business is only B2B, and I built a massive direct-to-consumer business. And one of the things that I saw at freecreditreport.com, we had relationships with American Express and with Quicken and that type of thing. I saw much better retention and much better engagement. And I made a decision. I said, credit unions and banks spend a lot of time building a relationship with their consumer. I would rather help them, build on that than try and go it alone. And we see that 75% of consumers would prefer to have all these services through their banking relationship with their primary financial institution. And so we try and drive that. We try and drive the success of banks and credit unions out there. And so far, it's been pretty successful. So I'll open it up for questions and appreciate everybody's time. Sorry we got cut a little short. We got a mic coming around. There's so much good data. There's no questions. Hey, Rich, you could probably have an anecdote. You got something to say?
So, question: what part in your offerings do you have with borrower education? I mean, actual, not what is a checking account, what is a savings account, traditional financial literacy, but like borrower education on how to build their credit profiles, how to maximize their fundability.
Yep, great question. So early on, and we're probably going to bring it back, we used to do the SavvyMoney Minute, which is these little bite-sized bits of education on borrowing smart, how to do a budget, how to manage certain things. We have tons of content all built into the SavvyMoney experience, so you can actually go in and put in your topic, and you'll come up with tons of articles. So Jean Chatsky is our director of education. You guys maybe know Jean. She's been in the industry a long time, used to be on the Today Show. And we're dusting off, and actually as part of our client council that's coming up, we're going to be bringing back content, personalized content. But how I want to do it again is bite size. If you provide too much content for too long, people will tune out. But if you give them a little bit of content, a little bit of a goal of something to do, I think you'll get movement in terms of behavior.
Yeah, along those same lines, I mentioned earlier that I did a lot of research around the intersection between psychology and finance, and during that research, I've developed kind of a battery of quizzes, of financial assessments that we've really boiled down into very bite-sized 3 to 5 question quizzes that come immediately with results that are very consumable, that teach people how this particular psychological construct relates to them, not just in their own lives, but financially, very specifically. And we have so much data around how different mindsets and different psychological factors actually relate to the way that you spend money, the way that you save, all sorts of things, that we can give these things in very quick, very consumable, very understandable ways, and provide some options for actions. My phone and my watch are going crazy on me right now, but the really actionable insights that people can then take and make movement on, not just here's something interesting about your personality, but what can you do with that knowledge now, and how can you apply that to your financial life? So
awesome, Akshay.
The line index has 4 indices: account, accrued, monetary value. So we tell you what is the monetary value of the accounts that you're linking and how it could be improved. We have financial responsibility index. In your universe, if you're earning $3,000 per month, how responsible and how you can change it. And then we have recoverability. Like from a lender's perspective, somebody was to give you money, how recoverable are you, and what you can do to change that perception in the lender's eye. So we educate them about that. And then of course that app engagement index. So we provide this, and we also are extending that to credit unions and banks, so they could help their customers. Because customers don't know this. They often see a yes or a no, and they're like, why? Like, I'm doing so well. And so we want to bring that front and center. That's what we do.
Hey, so before I ask this question, I wanted to show you what's on my back, because it's something that we actually trademarked. It pays to be savvy. So along the lines of financial wellness, financial literacy, teaching people what to do, the little things that you do that you make changes in your life will have an impact over time. And so it really does pay you back to be savvy about how you manage your finances. Question.
Okay, my name is Rich, CIO for Hughes Federal Credit Union. We do use SavvyMoney. A lot of the product that you're talking about that you guys use is after somebody's got themselves into financial difficulties. And what I've learned over the summer of providing financial literacy classes to career and technical education teachers that teach Gen Z is even they don't understand financial literacy. So if they don't, and the kids don't, and I know those kids' parents don't, our focus is shifting now to how do we educate the 12, 13, and 14-year-olds from a financial literacy standpoint so that they understand what financial wellness is before they get into that situation. So how do you pivot from where you are? How do you work with the parents to help them with their children from a financial education and literacy standpoint?
Yeah, I think it's a great point, Rich, and you can't pull your credit report until you're over 18. And so that's another challenge. A little anecdote, back, for those of you that remember, we used to have those commercials, the freecreditreport.com commercials, the guy's in the car, and the car's crappy, and he doesn't want to work at a terrible restaurant, and like, he won't get chicks, and like that whole thing. Well, our awareness exploded with youth watching those commercials. And actually what ended up happening is there's a whole group of kids now that think credit is important because of those crazy commercials. And the point I'm making is that if you make credit like blah, 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 kids are gonna be like, I don't hear you. But you come out with a funny ad, or even Geico or something like that. Freecreditreport.com did a great job of making credit funny, like, oh my God, like, I don't want to be a loser, like, I better manage this stuff. And it worked. And we saw great awareness in that. And so I think one of the things, Rich, you have to do, you better make credit fun, you better make it interesting, you better make it interactive. And I think, yes, you have to start early, but if you make it blah, 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 they're going to tune it out. Any other questions?
Doubling on that, what we have done is, as we mentioned earlier, meeting people where they are at. So we changed our entire interface to make it feel like what they're already doing. It's like Instagram. The financial education is coming like stories or reels, and it's very, very short. And the more they engage, the more it'll expand. But if they don't want to engage, it's super bite-sized for them to consume. And you don't have to just manage your finance, you can manage your entire family's finances. And so when we do Line, we expand it for the entire family, and that's what's helping us out.
All right, we've got 2 and 2. I always wanted to do that, Chuck Willery. 2 and 2. Minutes left for questions. Cool, we got one back here.
Have to for recording, so we will use the microphone. Very simple question, but could get different answers. How would you define financial wellness? And that might inform a little bit about how you're specifically thinking about it in your different organizations.
Go ahead.
That's a great question. So for us, I think that's something else that's changed over time. Early on, we were just at war with debt. We felt like debt equals stress. Financial wellness means no debt. And unfortunately, the research just doesn't completely support that. Not all debt is created equal. A lot of people think differently about student loan debt or auto loan debt. If you got a sweet ride, that debt doesn't feel as bad as the credit card debt that's high interest and revolving. And so the other thing is that the relationship between debt and happiness has kind of a murky, it's murky. So you basically, what we've changed here, sorry, I lost my train of thought there for a sec, but what we've really shifted to is cash flow being the main driver for wellness. And what we really want to focus on is helping people fund their happiness. And what that means, in my mind, is we want to give them the most purchasing power, the most spending power that they can have. If they need credit, then we want to make sure that they have the lowest interest rates that they can possibly get. And we want to help them build positive cash flow, live within their means, focus on what is essential in their spending and what will actually drive happiness, rather than just spending mindlessly and running up credit cards.
So I'm going to make one last point, and I think we're done. But I think the biggest thing for financial wellness is feeling in control. So feeling in control in any situation, which means you have awareness, you understand, you can have debt, but you can have good debt. You need debt on a car to get to work. So having an understanding of where you stand financially, what things you're doing to improve it, but being in control of your finances and having it not control you. That makes the biggest difference in terms of financial wellness. And it'll kind of add on to everything that these guys are saying. It all comes back to awareness and control. And I don't know if you want to have one last thing.
Yeah,
I think we're going to wrap up. But
so financial wellness needs to be, it cannot be homogeneous. You can't have one definition of financial wellness and fit everyone into it. Financial wellness has to be defined in that individual's universe. Some people cannot spend as much as they earn because their financial situation is changing, or they had an unexpected event. So financial wellness has to be heterogeneous. It has to be you have to look at it from each individual. Each individual's definition differs, and more solutions you build where you're empathizing and in that person's universe, I think more success you will find in the solutions that you build for these users.
awesome. Thanks so much for your time, everybody. We appreciate it.